What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. Today, we're going to talk about mobile home parks and some of the tax benefits related to investing in them. Most people think of real estate investing as you're dealing with single family rentals, maybe multifamily homes, short-term rentals, been really popular lately. But mobile home parks they sit in this weird space where demand's strong because affordable housing, there's a bit of a shortage there. Supply's limited. It's hard to get new parks developed. And then for tax purposes, they can really be beneficial if they're structured properly. From a tax perspective, mobile home parks are a bit interesting because a chunk of that purchase price is going to be allocated to things that you can depreciate faster than a normal building. So you might not own the actual mobile homes if you run a mobile home park, just the land and the infrastructure, which can change how depreciation works. So this can be very useful when you use a cost segregation study and bonus depreciation. So let's say you buy a mobile home park for $2 million, easy math. What are you really buying? Initially, the purchase might be broken down into your land, just like any other real estate asset, not depreciable. Then you have land improvements like roads, the utility lines, pads, fencing, lighting, drainage. And then maybe there's some building structures like a small office, a place for laundry, some storage buildings. And then there's personal property often as well. So signage, equipment, maybe the park owns a few of the trailers in some cases. So the idea is the more that $2 million you can allocate away from land and into things with shorter depreciable lives, then the more depreciation expense you get early on, which lowers your taxable income. So, depreciation is that non-cash expense. You never write a check for it, but it reduces your taxable income as if you did. And that's really what drives a lot of the tax benefits for a mobile home park. So just to kind of review depreciation basics, with a mobile home park, the value is going to sit primarily, a significant portion is going to be in infrastructure like the paved roads, concrete pads for the mobile homes, utility hookups, curbs and gutters, your storm drainage, signs, lighting. So a lot of this falls into that 15-year land improvement category for depreciation purposes, which makes it eligible for bonus depreciation. So rather than depreciating one big building over 27 and a half or 39 years, you're kind of slicing that park into buckets, and some depreciate faster, just like you'd have to use a cost segregation study, but it's going to work just like you would do with any other building in a cost seg study. However, you can often find a higher allocation when it comes to mobile home parks. So what's happening here, instead of, the park being one big asset depreciated over, let's say 27 and a half year, have fun waiting for a few decades, we're going to say X percent is the 15-year land improvements. We got Y percent that, they're for your 5-year property or maybe 7-year property. And maybe you have some buildings. You have some portion allocated to buildings if there's structures on the land, pretty common, especially if it's a decent sized park. And then there's the land. So mobile home parks tend to lean heavy on those improvements, not so much on the buildings, which means very great candidates for cost seg studies. Now, it's not unusual, depending on the deal, the structure, the year of purchase, for investors to see those nice paper losses and a big percentage of their initial equity coming back to them as tax losses, even when the park's cash flow positive. So quick example, let's say we have a $2 million mobile home park. Really simplified hypothetical here. You buy the park for $2 million, run a cost seg study. Turns out you have $4 million allocated to land, so no depreciation there. In this case, let's say $800,000 is going to the land improvements like roads, pads, utilities, utility lines, and hookups. And then you've got your 5-year personal property, signage, equipment, some fixtures. Let's say that comes in around $200,000. So you've got $1 million now allocated to the 5 and 15-year property. And there's maybe probably some small structures to make up the difference, that remaining $600,000. So total depreciable basis is the $2 million minus our land of $400,000. So that's $1.6 million. But the 200,000 5-year property, 800,000 15-year property, both are bonus eligible and can be written off in year one now with 100% bonus depreciation. Now, just a few concepts to understand. We discuss this all the time on the podcast, but should be mentioned. By default, rental real estate is considered a passive activity. Mobile home parks are going to fall into that category. So your passive losses typically can only offset passive income. They're not going to offset your W-2 salary or your business income. And if you don't have enough passive income, those losses, they don't disappear, but they're carried forward. They're suspended. So suspended losses can help you in the future offset passive income. But when you sell your interest, if you sell a park, any suspended losses would be freed up. However, if you qualify as a real estate professional, then that opens up the door to deduct those losses. So if you pass the test, qualify as a real estate professional, and you materially participate in the activity, in this case, running the mobile home park, then your rental losses can offset your non-passive income, like your W-2 or other business income. Like maybe if your spouse has a high-paying W-2 job. That's where the mobile home park benefits really come into play. And it takes it from, that's nice to, wow, that's a really powerful tax saving strategy. So beyond the cost saving and accelerated depreciation, there's a few other angles worth mentioning in here. So a lot of the mobile home park investors, they'll buy distressed or undermanaged parks and invest heavily in upgrading things like utility systems, improving the roads and paths, adding lighting and security, signage, maybe some curb appeal improvements. So a lot of this spend in like a value add deal like this goes into those improvements with shorter lives. So again, more depreciation. So the value add strategy really lines up nicely with the tax benefits here on the mobile home parks. There's also two ways the mobile home parks are operated. So you have like park owned homes. So the individual units, the trailers, the mobile homes, they're owned by the park, and then tenant owned homes. So two big difference in business model. So the tenant owned homes, you rent the lot, meaning the tenant owns their mobile home rather than you. And then with a park owned home, the park owns some or all of the actual mobile homes and rents them out. So park owned homes, they're going to change some things on depreciation. There's a bit more risk. That you could run into some possible ordinary versus rental income questions depending on how it's structured. But from a tax angle, park owned homes, they give you more depreciable assets, but they can change the character of the income and some complexity with the operation. Most operators, at least those that I know or have talked to, they prefer the tenant owned homes because now the tenants have skin in the game. So you have lower turnover on the actual structure. So those tenants, they own their mobile home. They're paying the operator rent to park it on the lot. So you're primarily monetizing the land and the infrastructure. So the infrastructure is that stuff with those nice improvement lives that can be bonus depreciated. And it keeps the tenants involved. They have skin in the game. They're an owner now. Those tend to be the preferred way, at least from my experience, what I've seen. Now, when it comes to exit strategy, there's the depreciation recapture is always an issue when you're dealing with cost seg studies. So, what happens when you sell? If you eventually sell, you're going to recognize gain. So if you sell it for more than your tax basis, there's a gain. Part of that gain is going to be depreciation recapture, which is tax at different rates from like your strictly long-term capital gains. So a lot of people look at this and think like, really, I'm just kicking the can down the road. And that's partially true, but you have the time value of money. So deductions now generally going to be more valuable than a deduction later. If someone's going to give you $10,000, would you rather have it today or in 5 years? Right? Obviously, you would say today. You might be in a different tax bracket in future years. You could use a 1031 exchange of the mobile home park to roll it into another property, continue deferring the gain and not pay tax when you sell or exchange. So not all the gains treated the same. So you got the recapture, some section 1231, some's capital. There are ways to plan around to move things into the more beneficial buckets if it's done right. So the mobile home park tax benefits kind of let you smooth and shift when you pay taxes. You could potentially pay less overall depending on your strategy. You need to plan for it. You don't want to just buy, bonus depreciate everything, and then forget about it and sell one day without doing any type of planning around it. So, Mobile home parks might not be for everyone, but from a numbers and tax perspective, they could be really compelling because strong demand for affordable housing. There's limited new supply, heavy infrastructure tends to result in large depreciation potential. The cost seg and bonus depreciation can really supercharge those tax benefits and let you create that cash flow, but with paper losses in the right structure. And as always, just you don't let the tax tail wag the dog, the investment dog. Make sure the investment itself makes sense, and then kind of do the smart tax planning afterwards as a bonus. So that about does it for today. If you enjoyed this episode, do me a favor, share the episode with a friend who invests in real estate. And if you haven't yet, hit that like and subscribe button so you don't miss future episodes. Until next time, have a great day.
Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.